Welcome to Stock Talk with Nico Criticos. Today we're going to be going through Jpmorgan Chase stock, ticker JPM. And as you can see here, the stock is now $140 a share. In the last couple of weeks, last couple of months, it's definitely had a good run. It is up over 21% in the last 3 months, slightly down on the year by about 9%. And here's the 5-year chart. So what we can see is this stock has been having some success lately because mainly because of interest rates, but also for other reasons as well. And so we're going to go through my checklist for this company, and we're going to see if this is a good stock to purchase right now or not. So, well, first off, I bought this stock recently, not at the bottom, but right at about $115 a share. I believe I bought it, I think probably around October. And I actually sold it in December, so 2 months later, and I sold it about $135. So in the matter of 2 months or less, I made, I believe over a 25% return. So I was pretty happy with that. I thought, okay, let me take my gains and I'll leave. And because I was not expecting it to go, to 140 and beyond, really. But here we are sitting at $140. So first thing on the list, is the stock oversold or is the stock down? I would say no, not really. It's more towards its all-time highs than it is its all-time lows. Then we're going to look at revenue and net income. And what you're going to see here is that although revenue and net income both grow pretty nicely over time, revenue is more consistent, net income is more volatile. So here you can see all the way back to 1986, 2022, when they just did over $32 billion of revenue. They consistently grow it every couple, every year, every couple of years, it goes up and up and up, right? So pretty solid there. Then if we look at net income, it's similar, but it still goes up over time, but it's more volatile. There's bigger dips and there's bigger spikes in net income. In the most recent year, they did $9.7 billion in net income. And so once again, this is one of the world's largest banks, very powerful bank, very tied in with the US government and the economy. And they're making over $9 billion of profit per year. So both of those are going to get a check. Then we're going to get to the PE ratio. And what you will find is most banks in this sector, the larger banks, they will trade at around a PE ratio of about a 9. And what we see here with Jpmorgan Chase is it's trading at 11.8 right now, forward PE of 10.3. So slightly higher than where it normally trades. But again, this will happen at times when if the stock is in a certain situation, like right now, interest rates are super high, that's benefiting Jpmorgan Chase. So that's why it could trade a little bit richer throughout 2023 until the Fed starts dropping interest rates again. And let's see, what else can we look at here? That's the main thing with the P ratio for this year. It's so really what can happen is this stock I could see this stock returning to $150, $160 a share if it was to push back up into that higher range of the P ratio of where it normally trades. Because you can see here, it hovers around a 9, but it's back in 2011, it dipped all the way down to 4.6. And in 2017, at the end, it spiked to 14.5. So it can fluctuate between a 5 all the way up to a 15 maybe. And right now we're definitely on the higher side. We're all the way up to 11.8. So it could push it a little bit more and get to a 13 or a 14, something like that. And then this stock can go up to $150, $160. But that's really the only way. And then once it does that, that's starting to push it. And I would say it's going to fall back down eventually and probably come, back right around to probably around $115 a share at some point afterwards. But that one's going to get a check for number 4. Number 5, is the company innovative? Do they have a moat? I don't know how much this company is really innovative. I would say more so they have a huge moat. How I said, they're such a big and important bank. When they're of this size, let's say, what is the market cap's like $413 billion. So with this big of a bank that has such a connection and such, the United States government is tied in with Jpmorgan Chase. The amount of money they manage is so large that they can't really afford to have this company go under. So like if you look back to the financial crisis of 2008, that was really when there was a chance for the whole financial system and these large banks to go under, and that did not happen because the government is almost always going to bail them out. That's just how it works, because it would be too catastrophic of an event for a company like Jpmorgan to go under. Number 6, is the industry growing? I would say yes, banking is growing. Chase, I don't think they have too many problems adding users, so that's not really an issue. How is the return on invested capital? This is a very nice chart. It's not very often you get to see a company that over the span of a decade like this can go from a 1% ROI all the way up to an 8%. And this is a fairly consistent chart. Right now we're at 6%, which is not fantastic. But I mean, again, look how much money they're managing. The investment was $588 billion. And just with that 6% return, they're making over 35 billion of income. So that's really all you need. Healthy cash flow. Let's go to their cash flow statement here. So what you will see with their operating cash flow is very volatile here. 2019 was 6 billion. Then we saw negative 80 billion during the pandemic. Then 78 billion last year. And the trailing 12 months is almost at $91 billion
versus the other guys,
which is huge. What
Hyundai has and what
So, and we can also see lots of money is coming out for investments. Lots of money is coming in from financing, and their cash position has definitely grown a lot, all the way up to $678 billion now. Free cash flow is that a check. Then we get to diverse revenue streams. I would say yes. I think they have how many customers? I want to say, let me see. I believe it's 60 million. No, wait a second. I believe it's close to 60 million. Yeah, 66 million households and over 5 million small businesses. So not only that, but they make lots of money through all their different types of accounts, their loans, everything they do. There's lots of ways they're making money. So not really a problem there. Again, they're such a big bank that I'm not too afraid of anything that could happen. Number 10 is the equity growing. Yes, it is. What you'll see here is in 2019, it was 261 billion, and a year ago it was 294. In the last 12 months, it has come down a little bit, but nothing substantial. Then we're going to get to is the equity of the company over 15% of the market cap. Yes, again, 288 billion in equity with about a $400 billion market cap. So that'll get a check. Next up, how does the share count look? What you'll see here is that although for the majority of this time, from 86 to 2011, they increased share. From 2011 to now, it's gone from 3.9 billion to 2.9 billion. So very lots of improvement made in the last 10 years. So that's good. The share buybacks are going to help push up that stock. Next up are insiders or big money interested. Lots of big money owns the stock. As far as insiders go, this was kind of weird. So 2 months ago, there was multiple insiders, including all these different people, the vice chairman, CEO of commercial banking. They were selling the stock right around where I sold it, $135 a share. The last purchase of an insider hasn't been since about a year ago, and they bought it at $150 a share. So kind of odd there. That's why it's not always good to go off of what the insiders are doing, but you would think there'd be some insiders purchasing shares, but I guess not. However, the hedge funds and big money has definitely been investing into this, so there's that. Is the management respectable? I would say yes. They've grown ROI, they've grown net income, they've grown the equity. I like Jamie Dimon. I would give that a check. Do they have more cash than average income? Well, their average income was what, about 40 billion, I believe, 40 billion, and their cash is 644 billion. So they definitely get a check there. Do they have a healthy dividend? Yes. Let's see here. Here's their dividend. So over the last 10 years, they managed to grow it about 12% per year, which is fantastic. Now they're up to $1 dividend per share. And then we can also look at how much of their cash is going to dividends. So what you'll see is that in operating cash flow and 13 billion went to dividends. So pretty healthy amount there. I would say that's safe. Finally, is the company over 20 years old? Yes, it definitely is. So this company scores a 16 out of 17 on my checklist, which is very high. And I would consider this a great investment, besides for the fact that it's on the upper range of where it normally trades. I think if you're buying it at this price, I wouldn't expect much. I would say best case scenario, you get to about $160 a share or so, and then it's going to start falling and it's going to come back down to 110 or 115. So just be expecting that. But in the long run, this is a safe company to own. And I would say, personally, I'm interested in buying this when it comes back down to like 115. But until then, I'm just going to keep an eye on it and we're going to see what happens. So thank you for watching, and I will see you in the next